Good morning, everyone, and thank you very much for joining me. This is the DAX Open with myself, Russell Shaw, Senior Market Specialist at FXCM. My email address, rshaw@fxcm.com, and I just want to encourage anyone that needs to contact me, please go ahead, send me the email to this address, and I'll respond as soon as I'm able to. Today's Wednesday, it's the 8th of December. Just going to bring up our disclaimer. So the first one would be the high risk investment warning. I'll just keep this on screen for a few moments. And just the commentaries disclaimer here. And just finally, our references, we'll do the analysis on MarketScope, but before we get there, let's just go through the CNBC morning note and see what the news stories are that we need to be aware of. So, excuse me, just starting off, European markets head for tepid open as investors digest Omicron news. European stocks are expected to open modestly, with investors continuing to digest the latest news around the new Omicron variant. This comes after a strong session for Europe yesterday, with global markets rallying as concerns about the potential severity of the Omicron variant eased. There's been mixed news. Pfizer CEO Albert, I hope I pronounced this right, Albert Bourla on Tuesday said the Omicron variant appears to be milder than previous strains, but also seems to spread faster and could lead to more mutations in the future. So I think we knew that. I think we were of that opinion. However, South African scientists said Tuesday that Omicron significantly reduces the antibody protection generated by Pfizer and BioNTech's vaccine, according to a small preliminary study. So I did read that on one of our local sites. Still, people who have recovered from the virus and received the booster shot will likely have more protection from the severe disease, it says. Just what I read earlier this morning, and again, I don't have the website, so if anybody wants it, just email me. But the article I read said there's elements that do bypass the vaccine, but only elements. It's still offering protection. Earlier, the White House Chief Medical Advisor, Dr. Anthony Fauci, said preliminary data from South Africa last week was encouraging, as it suggested Omicron is not as severe as initially feared, while noting that more data is needed to fully assess the risk posed by the variant. In the meantime, the US CDC, that's the Center for Disease Control, said Tuesday that the new variant has now been found in 50 countries and 19 American states. Overnight in Asia Pacific, Hong Kong stocks lagged other markets, with troubled Chinese real estate developers back in the spotlight. Chinese social media giant Weibo also had a disappointing market debut in Hong Kong. Just with regards to this over here, Chinese real estate developers, I think this is a story we need to try and just keep on top of. Because they are starting to miss debt payments. It's sort of starting to spread from Evergrande. There's somebody else that's just missed now. Right now, I don't think it's a big deal. I just want to keep an eye on it because there's something called systemic risk. Systemic risk is where it kind of spreads. So the global financial crisis started off with subprime mortgage. That was systemic. It spread to all corners of the market. So if you wanted to raise money, you couldn't, because the credit markets just closed up. At the same time, equity markets falling. When I say closed up, they weren't closed. They just kind of became extremely adverse to risk. You couldn't get any credit. It just was a chain reaction. So it's just, this over here is just something I think we need to keep an eye on. The US stock markets also rose in overnight trading on Tuesday. And All right, earnings from TUI. Okay, I think that's the end of the article. I see there's some comments here. I'm just going to bring up the chart here. All right, let me just see the comments. Shadrach's just asking if we can look at the euro-US dollar. Yes, we certainly can. Yeah, and Peter, definitely. Smiles all around the DAX rally yesterday. So yeah, I think that's a perfect way to sort of introduce today's session. So there was a terrific rally on the DAX yesterday. These lines, that is, were drawn in yesterday. So you can see the progress since, right? So we were just kind of breaking this resistance, and of course there was a nice breakout, and the problem was it was getting overbought, and that's now actually resolved itself. So the RSI has normalized. So that's, in my opinion, that's good, because it kind of removes the potential cap on gains, because overbought markets tend to normalize. So that sort of implies a cap at some stage until that normalization takes place. Well, that's good to see. Let's take this out. What I think we need to keep an eye on, and we are starting with the hourly chart here, so we'll kind of work our way up. I think that the central pivot is clearly the first key level that we've got to look at. Let's get rid of all of these. Okay, so I think this is a good key level to start the day. And the reason is, well, 1, 2. Now we've got to assess, is this a 2-3 correction? Assuming it's a 2-3 correction, maybe it's the platform that we need to watch for the next leg up. Now, we don't want to forecast, okay? That's why we watch the central pivot, because that's the obvious first level that if there is some support, that's potentially what the bulls are looking at. We don't have to be the first ones in, okay? So we will monitor our triggers. So the exponential moving averages need to turn positive. So you can see they've rolled over, and I'm just zooming in here. There we go. They're looking to cross bearishly, and then of course the stochastic. And when we talk about the stochastic, it's actually this blue line. This blue line is what's called the percent K, and then the percent D is kind of like a signal line, right? So the percent K is the stochastic. The percent D is a 3-period exponential moving average on. So that's kind of the, so you can see percent K has fallen out of the 80s. So we just want to see it come back into the 80s. So the correction down to central pivot, I think, is the first sort of item on the list. If that fails, well, that's okay, because we won't get any triggers, right? That's why we're looking at the triggers and not forecasting. So if it fails, then we're going to watch the S1 level. And both these levels here, I think, can be looked at in terms of maybe just a big area of support. Let's just see. So here, so the central pivot has this area. It's not particularly meaningful, but here's some sort of support that's come in, and here's a little bit of resistance, maybe reaching there. It's not quite as obvious. All right, so let's just keep an eye on the central pivot S1 levels. Central pivot, the first order, S1 sort of the second order, and we don't have to be the first ones in, we just have to be early, right? So just to give you an idea here. So let's just say we got in only there, right? That's still a significant swing. You know, there's still nice swings there, and it's in my opinion, and probably statistically a better risk-adjusted entry anyway. So just reiterating the fact that we use triggers, right? So looking for a trigger there, looking for a trigger here, which I'm missing. And the good news, of course, we're not overbought. Let's just work our way up. Okay, so now we've looked at the hourly, we've got the key levels that we want to watch. Let's go through to the daily, and this is terrific. This was an unreal move. Now this is a huge amount of emotional trading, and the reason I say that is the range of a candle is the perfect way to assess emotion. So the sell down here, so this was this Friday sell down, not this recent past Friday, the Friday before. Look at the emotion there, right? That was just absolute bearish fear, completely dominating. But this is bullish greed, I guess, dominating us. Not quite as strong. That's not a surprise. Fear is a much stronger emotion. That's why sell downs, bear markets, they're much shorter than bull markets, but they are so much more vicious. The amount of damage that a sell down can do in a brief amount of time is astounding. Just to kind of bring that home, let's just do this. Okay, so our first blue vertical is 6th of October, and we get a peak here of 18th November. So it takes us just over a month. Just over a month to build from there to there. It takes a few days, and all those gains are wiped out. And that's what you'll see repeatedly in these real fear-driven sell-offs. Like the global financial crisis, sell down only ran. I can't remember. It was a very the end stage was a very fast sell down, but it took out 50% of the gains that took. I'm just trying to remember the years. The bull market started in 2003. We went all the way up to 2008. So 5 years of gains was wiped, or 50% of gains built up over 5 years was wiped out in a matter of a month. Just that last panic selling. So it's not surprising just to see a much longer candle on the way down. But the fact that this is a nice long candle on the way up, I think, is good news. I'm just going to go and mute for a moment. I just feel a cough coming. I beg your pardon. Easier to fall down the stairs, absolutely. Absolutely. So that's from Peter. And I think the exercise for us now is to monitor the zone, the neutral area. And ultimately, we want to see if we get back into this area of strength, what we call zone 1. I'll just put it as zone 1. So we want to get from zone 2, which is our neutral area, into zone 1. This is a nice sort of way to start that move. Again, we're not going to forecast. I don't know if we're going to get into zone 1, but if we hit the central pivot and we get our triggers, or if we hit S1 and we get our triggers, well, that's a good way for the market to suggest that it's trying to get into zone 1, right? And the reason it's important to get into zone 1, and the reason that it was important to get out of zone 3 just going to take these out. The reason that I changed these sort of vocab was for the articles. They haven't, whoever's reading the articles, I'm not sure they'll understand what zone 1, zone 2, or zone 3 is. I think we all do. And the importance to getting to zone 1 is because that's where trends are built. Okay, that's where trends are built. So if the next swing or the next short-term trend is to start, but it's not going to start in zone 2. Okay, zone 2 is not good enough. It has to get into zone 3. I beg about it. It has to get into zone 1. It has to move in zone 1. That's how we're going to get ultimately higher prices. So if we don't get there, that's not good. But the fact that we moved out of zone 3, that's good, because just like zone 1 is where uptrends or upswings are built, well, zone 3 is where downtrends and downswings are built. So the fact that we're out of there is good. Nevertheless, we don't want to forecast. I want to just make that very clear, and we want to just make sure the triggers give us something to work with. Now we'll go through to our weekly. Let's just go and market open. Just give me a few moments. There we go. All right, we'll just go through to our weekly now. Today is sort of the middle of the week. We want to see this chart at the end of Friday. We will certainly be examining it. I'm tripping over my words. Examining it on Monday when we do the DAX. And the whole idea there is for us to have 3 conditions, because that's going to be a good way to start next week. It's kind of the dip in the uptrend, right? The dip in the uptrend. Will there be a sustained movement after that? Again, nobody knows. Okay, but I can say without those 3 conditions, then we won't have a movement up. We may have a sideways movement, we may have a movement down, we won't have a movement up. So these 3 conditions, okay, I think is clearly something that we all need to keep focusing on. There is a movement of the RSI above 50. The stochastic's got a lagging factor. We want the stochastic back to get back into that upper quintile and stick. You guys know that we've spoken about this over and over. The stochastic for me, yeah, it's my favorite indicator by far, because it is a real measure of momentum. Again, you know, everybody's comfortable with their own indicators, and what's sort of my favorite might not be somebody else's, but the idea of hitting sort of an extreme on stochastic and holding, to me, is exciting. And that's exactly what happened yesterday on the hourly. We spoke about this yesterday when we were just you know, talking about is there going to be a movement up? Well, the only real conclusion is if we maintain above the 80, if we are maintaining the upper quintile, yes, there will be a swing. Well, yeah, there was a swing. Terrific to see. The fact that we're not in the upper quintile now, okay, so we've got to watch now. The upper quintile, or the 80 and above, it's not a magic number. It's actually a very it's an application of a strict application. Somebody might say, look, waiting for price to get into the sort of top 20%, it's a little rigorous. I'm going to look if it gets into the top 30%. So I'm going to look from 70 and up. That's fine. There's still obviously a strong momentum there, right? So we're kind of still we're in the right area, but I think that we just need to get this moving up. Incidentally, just as I'm talking, there is a bit of blue that's coming in here, but don't rush in. Okay, we know the first 15 minutes are very foggy, so we just want to give the market some time to breathe, and we'll see if we get the triggers. Now, I'm going to move on to Euro US dollar. And then I think what we'll also do is just have a quick look at Bitcoin, which we usually do on Wednesday, but I haven't had the opportunity to run the crypto minutes. Before I go into the Euro, just want to ask if there's any questions for the DAX. Go ahead and type those in. Otherwise, I'll move on to the DAX and then we'll do Bitcoin after that. All right, let's have a quick look at Euro here. All right, so it's a similar application of our methodology, right? I think for Euro, it would actually be easier to start from the top down, just because it will give us the context. For the DAX, we kind of following on from yesterday, so we had a context. So let's just do a top-down analysis for Euro US dollar, and so on a weekly basis, you can see that the trend's down. So let's just state that up front, and you can see that the stochastic is in a it's what we call the lower quintile, the bottom 20% of the range. So there's momentum to the downside. I think that we've also got to just keep an eye on this RSR. It is getting quite low. Let me just bring on a legend here. So we're at 20.10. So we're above 20, but 20 and below is basically our oversold warning. The problem with overbought, oversold on a weekly is, of course, it doesn't really help with timing because it's a very broad time frame. So it's a hard time frame. It will normalize, but I mean, because it's a weekly chart, it may normalize in 1 week, 2 weeks, 3 weeks. You know, which on a weekly time frame is still sort of short. It's three candles, right? So, for example, we were overbought here, but it took. Let's just see where we went overbought. So we went overbought over here, which is, let's just call it week 1. Then it took week 2, week 3, week 4, week 5, week 6, week 7, week 8. So 9 weeks before we kind of moved out of that. But you can see there was a ceiling on it. There was a cap on it. So in terms of the downside for the Euro US dollar Shadrach, I think we must just acknowledge the weekly is getting quite low. Maybe there's a floor. Maybe there's a floor here in the near term. So in other words, I'm not sure how much lower Euro US dollar can go before we see some sort of normalization. So just keep that in mind. We go down to the daily chart here, and the daily chart is hinting. It is hinting at a floor, isn't it? Because it's out of that zone. It's out of that zone 3. It's in that zone 2. So it's moved out of the weak area after a vicious swing down. So it's now that volatility is starting to die down, so to speak. So the increase in volatility we know is because of the widening of the Bollinger's. You can see the Bollinger's now are starting to converge on one another. There's not a real narrowing there, but certainly the volatility for the time being seems out. Now, just a word about this is that next week, exactly. So today is Wednesday. So next week, Wednesday, we're going to have the Fed statement, and that's going to be interesting because there is talk that the Fed is looking to double down on the tapering. So instead of 15 billion per month, they're looking to taper 30 billion. I mean, that's a hugely aggressive change, isn't it? And that can really influence the dollar. And of course, if it influences the dollar, it's going to influence the majors. And of course, Euro US dollar is a huge currency pair to keep an eye on in terms of that, but it's a week away. and we'll just have to keep keep monitoring, understanding that there is an oversold condition on the weekly, but there is a real potential of the Fed to come in quite strong here. So let's just reiterate before we go into the hourly. Definitely downtrend in terms of peak and trough. Definitely weak momentum in terms of stochastic. Perhaps a little bit overcooked to the downside on the weekly basis. Suggested that that may be the case on the daily because the volatility is starting to narrow. And in that view, we go through to our hourly. And the question is, well, what do we do here? And to be honest, I think it's quite a hard call. The fact that the candlestick is in our neutral area here may be the overriding sort of filter, and for us to just say it's probably kind of a good period just to wait and see which way the market participants are looking to go. Are they starting to think that the euro-US dollar is oversold? Is it time to sort of get out of our short positions? And if we get out of our short positions, I would assume that causes a bit of a panic. That's what we call a short squeeze, and that just like everybody feeds off each other. And then once that's out, I think the oversold condition's out, you know, and that's potentially something that might take place. So I don't think I've given anything concrete or definitive there, Shadrach, but I hope it helps. Just let me know. I want to go through to Bitcoin now. Let's just go through to Bitcoin because it is making headlines. I did write an article on this yesterday, so I thought it would be worth just mentioning sort of some of the contents of that article. If we go back to the weekly for Bitcoin, the Bitcoin weekly chart, this is going to sound crazy, but we're still in an uptrend. Why does it sound crazy? Because in less than a month, Bitcoin has wiped off a quarter of its value. So you kind of say, well, how is it possible to still be in an uptrend when you've wiped off 25% of your value? In fact, I calculated it to be 26% of its value. But the idea here is just looking at the peaks and troughs. The pattern for an uptrend hasn't been broken. Now, there is a line of thinking on Wall Street that a decline of 20% is a bear market. It's generally accepted. Okay, so in that case, we would call Bitcoin a bear market. But in terms of strict technical analysis, in terms of peak and trough analysis, no, it's not. It's in a correction. And the idea is it's pulled back to a 50% retracement off of its swing from its July low. And the question now is, well, what is going to happen? So I'm just going to go through to this over here, which is what I drew yesterday. So this green line is the same as this green line here, but I want to take the indicators out of it for this discussion. So I've put forward two hypothetical situations out of an infinite way that the market can evolve. I mean, we could have just weird things happen, right? So if we get a higher trough here off of the 50% retracement, and it follows the blue trajectory, well, that makes a higher peak. That takes this peak out. That means that that's the next higher trough, higher peak in the series, and the bull market continues for cryptos. The red line study shows a distinctly bearish case where there is a lower peak followed by a lower trough, which is a bear market. Now, just to add sort of a little bit of market statistics to this, I probably should have brought up a spreadsheet, and I haven't. Yesterday, I was just doing some calculations in terms of the standard deviation, which is problematic in of itself. In other words, what standard deviation generally is used for is to measure risk. Instruments with a higher standard deviation in effect have higher risk. Well, the standard deviation for Bitcoin relative to its, I'm just trying to remember the numbers, the 60-day standard deviation is over $7,000 off of a mean of, I think it was about 55,000. And that's one standard deviation, right? So let me just pump that into my calculator. But it's around 13%. So one standard deviation is kind of like 13%, whereas you take a look at, say, take a look at the S&P, and the S&P was only, if I recall, because I don't have the spreadsheet in front of me, I think it was 2%. But standard deviation is problematic because this is super interesting, by the way. I'll try to sort of make this as so you've got something called total risk, okay, in the market, and this applies to all instruments. Total risk. Now, total risk is effectively made up of two components. Okay, it's made up of two components. In terms of, say, the stock market, there would be individual company risk. Okay, so for example, Enron, if you recall Enron's failure, okay, that's sort of an individual company. If you were all in on Enron, you lost everything. So you got hammered by individual company risk. But there's a second risk, and that's called market risk. Okay, and these also there is something called market risk is also known as systematic risk, and individual company risk is called unsystematic risk. Okay, but we'll just call it company risk and market risk. Now, let's just talk about Enron here. I just want to make a point here, and it's super important if you're active in the markets. Let's just say you've got let's say you got $100, and you bought two companies. So you bought Enron sort of in the late 90s, and say you invested also in Microsoft. So you had 100. Let's say you had $100. You put 50 into Enron, 50 into Microsoft. Well, you lost your 50 on Enron. That's gone. Okay, that's gone. But you're holding Microsoft, and it's grown considerably since then. So now the point is, there's going to be two cases here, and again, this is case one. Case one is you put your full $100 into Enron. Okay. Case two, you put 50 into Enron, and you put 50 into Microsoft. Okay. So the question I'm going to ask you, I'll just pose this question: which is the better case in hindsight? Sort of with the comfort of hindsight, which was the better case? And we'd all see that it would be case two, right? We'd all see that. And what's the difference between case one and case two? Diversification. Okay, diversification is the difference between these two cases. Now assume that you added a third one, and you put in, let's say, Apple. Okay, and instead of going 50-50, let's say there was case 3 where you kind of went 33, 33, 33, right? Well, now Enron, the failing of Enron is not such, it's not a big deal, because you're left over with 2/3 of your initial investment plus. Now 20 odd years later, Microsoft and Apple have grown terrifically, so this 33 would be worth way more, despite this kind of complete this complete loss in Enron. The point being that there's a very important point here, okay, in that the more you diversify, the less your market-specific risk is. Okay, so in case 1, your sorry, did I say company specific? I hope I said company specific risk. In case 1, your company specific risk was intense because you were only exposed to Enron. If something happened to Enron, that was it. Tickets, good night, right? And something did happen to Enron. In case 2, in case 3, when you've diversified, what happens to your company specific risk? It reduces remarkably. Does everybody hear that point? The more you diversify, the less the company specific risk. So the obvious question is, well, how many instruments do you have to diversify to cut down your company specific risk? And the answer to that lies on various studies and various things. But so with one study says between 12 and 18, another one says 30, and they should have low correlations to one another. In other words, Microsoft and Apple might not be the best example here because they might have very close correlations. So how diversified are you? But let's just say we change this to, let's just say we change this to, I don't know, Coca-Cola, right? Well, those are 2 very different companies. Well, that's a fairly good diversification. So the point being that you can really get rid of your company-specific risk. You can really, but through diversification, you can get rid of it almost completely. Okay, that means that you are left with market risk. Okay, so if you can get rid of your diversifiable risk quite easily, chances of you being rewarded for something that you can get rid of fairly easily. You know, the market generally doesn't reward you for individual risk, but it would reward you for market risk. Okay, so when we talk about Bitcoin, it's got a huge total risk. Its standard deviation is huge, like off the chart, huge. But the more you kind of diversify, that's idiosyncratic specific risk to Bitcoin gets smaller and smaller and smaller, and eventually only market risk is kind of left there. So the measure for market risk is not standard deviation. Okay, your measure for market risk is beta. Okay, it's beta. So you can start measuring how risky something is with beta, and Bitcoin's beta is still huge. It's still huge. Just wanted to give you the beta numbers. So in the last 60 days, Bitcoin's beta is 40. That means, so what does that mean? What is a beta? So a beta of 1 means that you are matching the market 1 for 1. If it goes up by $1, the stock that has a beta of 1 will go up by $1. If the market goes down by $1, then the stock with a beta of 1 will go down by $1. So Bitcoin has a beta of a 60-day beta of 40. just to show you that there's still there's a huge risk. What I did then was I looked at it over 12 months, because 60 days and so we've obviously had a very volatile, and in 60 days the beta is 8. So the market risk is much lower on a longer term basis. It's 8. So it's still up, but it's against the beta of 1. Remember, market risk, the market S&P, that beta is 1. So this was a measure against the S&P 500. What's the whole point to this discussion? The point is that whether you are a Bitcoin bull or whether you're a Bitcoin bear, okay, you can make your own arguments for and against, but and either you're going to be right or you're going to be wrong. However, what I can say for certain is that it is a high risk. It's a high risk instrument, and that means you must understand the environment that you're participating in. If you are inherently averse to risk, well, Bitcoin's a high risk instrument. You see what I'm saying? If you are a risk seeker, well, Bitcoin's a high risk instrument. Okay, risk is a real thing. Okay, when you get involved in a instrument, okay, it's not the risk. You've automatically assumed risk. So it's either going to hit you hard, okay, or it's going to reward you in terms of that risk that you've taken on. But if it hits you, it's going to hit you hard. So I guess that's the angle I wanted to address in terms of Bitcoin. It's a high risk instrument. Whether you are a bull, whether you are a bear, the risk is extreme. And if you are operating in that environment, then one would assume you are a risk seeker. Otherwise, you shouldn't be there at all. What VIX readings would you avoid or use to gauge risk? So VIX is different to the VIX is different to kind of a statistical measure. So we've been talking pure sort of quants with regards to risk here. What the VIX actually is a measure it's a measure of the volatility between puts and calls, and specific to the S&P 500. Okay, specific to the S&P 500. So the way that I would look at the VIX, let me just bring up TradingView, which wasn't in the sources. So we just need to just acknowledge that we're going to TradingView now. I'm not sure what that is. I think that was actually the standard deviation. Let's get rid of that. So I think that one way to just look at the VIX is in terms of contrarian type of opinion. Now, clearly, it doesn't always work. In fact, because we are in what's seemingly a strong bull market, I would suggest the extremes up are probably kind of where you want to look, Chris, because those are probably good contrarian type of signals. So, for example, let's just bring in the S&P here. So you've got a big jump up here in VIX, just as the S&P 500 is getting sold down. What's that telling us? It's telling us that money is going into put options. The VIX is getting skewed sort of to the bearish side because a lot of money is going into puts. The reason that they're going into puts is because the put options are protection against downside risk. Also, speculators might be using them just to try and take the market down. But you can see that we are in a obvious bull market until proven otherwise. If that is the case, then these kind of spikes up in the VIX are probably good contrarian signals, whereas these sort of low readings here, where everybody's piling into call options because they want to try and take the option, they want to take, I guess, the leverage up, is working less well. So although there does seem to be some sort of excess contentment, so to speak, at this, it's really kind of the dips in the uptrend here, which seems to be paying off. So what type of levels? So I would say anything kind of from, let's just see if we can pull this in. Let's say anything from 28 and above. Does that help, Chris? That's how I think the VIX should be read for the time being. And that's just, I want to be very clear, that's my opinion. It's not a hard fact. I hope that helps. Any other questions there, guys? All right, let's conclude at this point. And again, everyone's got my email address. If you need to contact me, send me an email. Thanks very much, guys.